Hey, hello everybody. Welcome to JC Trading Course Part 2. We're going to talk a little bit about the instrument we'll be trading during this course, which is futures. It's a type of derivative and it might sound a little scary, but I assure you it's a very simple type of financial instrument. Okay, so what are futures? Futures are a hedging derivative, and what that means, a derivative is something that has an underlying asset. It's not an asset of its own, but it's actually dependent on something else. The price of this contract or whatever it is that is being traded is dependent on another price. And hedging means it can be used to reduce risk. So you can hedge against inflation, you can hedge against events, you can hedge against weather even. So futures are very useful for this. So futures have an underlying asset, a predetermined future date and price. So what this means, for example, you can buy oil futures. Oil is the underlying asset of this contract, and the predetermined future date and price means that on a specific date, this contract will expire at a specific price. So that's why it can be used to hedge, is because you are locking in a price on this certain date in the future. Hence, it's called futures. And they're standardized forwards contracts. Oops. What that means, so there's another type of derivative called forwards, which are negotiated contracts between buyer and seller, and they're usually done OTC, which is over the counter, whereas futures are done on exchanges, so they're standardized and they can be traded by normal traders, day traders like me and eventually you. So buyer and seller are obligated to buy or sell at the expiration. So if you're shorting it, you're obligated to sell it. And if you're buying this contract, you're obligated to buy the full price of the contract on the specific date. And they're traded in the secondary markets by speculators at least. So let me get a little, how do you do this? C pen. Alright, so we have this guy right here. And he's a wheat farmer, right? And he has 100 bushels of wheat that he wants to sell. And here we have, I don't know, protein bar producer, and he wants to buy wheat and lock in his price, so he knows what he's going to pay on the specific date. So these two, what they do, they put forward a futures contract. So they write a futures contract saying 100 bushels, HELS, at $1 per bushel on December 12th, right? So what they did, they've locked in the price and the date. So the underlying asset is bushels of wheat. Here's the seller, here's the buyer. So this guy is obligated to buy this amount from this seller on this date. Now, for example, say wheat goes to 90 cents on this date, on December 12th. That means the seller has profited from this. He's getting an additional 10 cents, which is a premium on the market price because of this contract. So technically, now his contract actually has a price. So there's a premium on this contract in contrast to the market price. Or say the bushels of wheat are valued at $1.10 on December 12th. That means this buyer is actually getting it for a better price because of this futures contract. So again, this futures contract is now going to be cheaper than it actually was because it's actually it's going to be more expensive than it actually was. So because right. So what kinds of futures are there? We're going to talk about these multiple types of futures. There's actually quite a lot. So there's agricultural, which are traded on the Chicago Board of Trade, and this means wheat, corn, many types of things. There's metals, which are traded on the New York Exchange. New York Metals Exchange, and so gold, platinum, silver, you name it. Index, which are the Chicago Mercantile Exchange, and index futures are S&P 500, Dow Jones, all this good stuff. So, for example, if you want to trade the actual market itself, you're going to be trading index. There's food, which are actually traded on NYMEX for some reason, and food is, for example, oranges, cocoa, lean hog. I don't know, lean hog would be livestock, but you get the gist of it. There's energy, which is oil, natural gas. There's currency, so um, euro, dollar, euro, pound, pound, dollar, Canadian dollar to American dollar, so on. And then there's interest rate futures. So what that means is bond futures. So 30-year government bonds, treasury bonds, the yields. So that's how you're going to be trading those. And then there's livestock. So lean hog, cattle. That's all on the CME, Chicago Mercantile Exchange. So there's actually only four exchanges that matter. There's actually a lot more, but they're small. For example, in Canada, there's the MX, which is the Montreal Exchange, which is where the Canadian futures are traded. So now, what can we do with futures? What type of trading can we do with futures? We can scalp futures. So, you know, well, the way these trades are defined is on the risk reward, and we'll be talking about that. But scalping technically means you have a 1-to-1 risk reward. So for every 1 point that you risk, there's a 1 point equal amount of reward that you're chasing. Then there's position trades, which are usually 1 to 2 or 1 to 3. So for every 1 point of risk, you want 3 points of reward. And positions have a longer time frame, so you might position throughout the day or like maybe 2 days. And then there's swing trades, and they aim for more than 1 to 5. So you want 5 points of reward for every 1 point of risk. And when you're swing trading, you're looking at a higher time frame chart, building context off that, and trying to cash an entire move down or up. Now, because of the high leverage of futures, we'll be talking a little bit about the leverage, I think, in the next slide. We're going to make huge gains even from scalping. So if you have a $5,000 account and you scalp for 10 ticks, which is 10 cents on oil, and oil has moved about $1.50 per day, so 10 cents is really nothing. If you scalp for 10 cents, that's $100 in your pocket right away, just on one contract. So very easy. Now, futures leverage, there's the margins, there's the initial margin. So the way futures work is, say, for example, let's say oil. So say oil is $46. Every tick of oil, which is 0.01, is equal to $10. So that means there's 1, 2, 3. 1 to 300 leverage, which is crazy. So the initial margin that you're going to put up for an oil contract at the moment is about 3,800, I believe. That's the current initial margin, and the reason it's so low at the moment is because I believe is because there's very low volatility. Not many people are trading oil, so the margin is very low at the moment. Usually it hovers around 6,000, but they put it down so investors are actually going to buy more contracts, which is not happening for some reason. And then there's the intraday margin, which is the amount you'll need in your account to hold one single futures contract throughout the day. So the initial margin is how much you need in your account to open the actual contract position, and then this is how much you'll need to hold it in your account. So for example, I think at the moment it's plus 1,000 for oil. So it's 3,800 plus 1,000. You need at least 4,800. And then there's the maintenance margin, which is overnight. I'm not too sure on this, but I think it's plus 500 for the maintenance. So there's all of this. And then if you're trading with a margin account, which is what I have with Interactive Brokers. They'll give you an equity with loan, so they do 3 to 1, I think. So for example, if you have an account with 15K, that does not look nice. They'll actually give you 45K. So yeah, that's your equity with loan value. And when you're trading on these futures, they're going to look at this number, which is nice. So again, I don't think it was too clear here, but so what happens with futures, you put down your initial margin, and then the actual future, the underlying asset, for example, for oil, is this times 100. So that's the actual value of the standardized contract. If it expires, that's how much you're obligated to pay, which is around $380,000. So that's the underlying value of the contract, but you only need to put up the margin to trade it because you're not actually buying the asset, you're only trading the contract. So they look at these margins right here instead of charging you the full price. And almost all traders don't actually let your contract expire. They require you to liquidate it before it does so don't worry about that. Alright, so end of video 2. I thought there was another slide. I'm wrong. So I'll see you guys in the next video, and thank you guys for joining us.